A lot of action in the market. So is it a bear market rally, or are we seeing a bottom finally? And maybe we'll see another bull market from here. It's really hard to say. It's difficult to predict when these pivots are going to happen and what they all mean. But let's try to dissect it bit by bit. So we'll look at what happened this past week, and we'll figure out the reasons why, and then we'll look at what's going to happen next week and try to put some pieces together to help us get a better picture of what we should expect looking forward. So let me share my screen. The first thing I want to tell you every time that I meet with you is that, of course, stock prices, well, I always used to say when people would ask me, why is the stock down? I'd always say there are more sellers than buyers, which in the short term is true. It's supply and demand. So, in the market, the prices are set by buyers and sellers who are willing to buy or sell a stock at a particular price. They look at the market value. Well, they look at the market price, I should say, not the market value. They look at the market price and they compare it to what their estimate is of the value of that stock or bond. And then they make their buy or sell decisions. And so sometimes people switch from being buyers to sellers and vice versa. So, whenever anybody asks me why stock is up or why stock is down, it's because there are more buyers than sellers, or there are more sellers than buyers. Those are the truths, and I know everybody here hates it when I say that, but that's actually how it goes. But why do people switch from being buyers to sellers, and why do investors switch from being sellers to buyers? And so I'm gonna beat you over the head with this every single week. It's because stocks have earnings. When you own a stock, you own a piece of a company, and you're entitled to the earnings. And we're right in the beginning of earnings season now, and earnings season has been really kicking in last week, and this next upcoming week, we've got some big companies reporting earnings. So it's all going to be about earnings this week, and that's something we have to pay attention to. But it's not just the earnings, because the reality is that it's the future expectations. Let me get down to the bottom. So when companies report their earnings, you're going to see a couple of things. First thing I tell you, their earnings, and then you're gonna, as an analyst, see if the growth rate accelerated or decelerated. And then, well, we've got this. This is the Fed. The Fed is messing with us every single month now. But then, that aside, then when the company reports their earnings and you do some analysis to see if the growth rate is accelerating or decelerating, the company's probably going to give you some guidance on future earnings. Now, not all companies do that. Some companies, in fact, have suspended guidance because things are so bad. But this is your future earnings here. So this is actually much more important than this one. Earnings are important, but future earnings are more important. If a company comes out and reports that, oh, we kind of stunk it up this quarter, but next quarter we're going to make 10 times more money, well, the stock's probably going to go up. We're going to buy back shares and repurchase a lot of stock, cancel all of our debt, call all of our preferred stock, and pay huge dividends because our earnings are going to be so high. Well, you know what? The common stock's going to go up a lot. It doesn't matter what happened in the rearview mirror. So anyway, let's look at this chart again, because I had some interesting conversations this week with people who were trying to build out a portfolio, and we're talking about, waiting for the Fed to cut interest rates and then rotate into growth stocks. And I said, well, there are growth stocks right now. And they're like, well, no, but I mean, the growth stocks are down. And I'm like, no, the growth stocks are not down. The growth stocks are up. They're just not the ones you're thinking of. And so I just want to make it clear that there are stocks that have growing earnings. They're not the ones you typically think of. They're not the tech stocks. They have declining earnings. They're not the semiconductor companies. They have declining earnings. Those are not growth stocks now. The growth stocks are whatever you see that went from red on the right to green on the left. And it's the stuff you don't think about being growth stocks. Consumer staple stocks, food and beverage stocks. Look at that. they're raising prices like crazy. And remember, we talked last week about PepsiCo. They raised their prices and revenue is up 17%. Energy companies right below that. Now it went from green back to red, but still, now that OPEC has cut 2 million barrels of production per day, these are investable again, and the price of oil is going back up. So food and energy are two big areas. Normally, I know you want to think of growth stocks as being tech and telecom, communications and technology. Nope, not right now. It's food and energy, and that's all there is to it. And then you've got the other stuff down here, like rent. Rent is way up. That went from red to green very nicely and is accelerating. So, maybe apartment REITs. And of course, you've got things like airfares. Hotels are doing great too, but airlines are full. All right. So I know I went over this last week and I went over it before, but I want to go over it again because I keep having these conversations with people and they keep thinking that growth stocks are, Netflix, NVIDIA, Intel, AMD, Taiwan Semi, and the FANG stock, Facebook, Apple, Google. Those aren't the growth stocks now. Those are pretty much across the board having shrinking earnings and the revenue is not doing that great. Now, that can change. That can definitely change. Certain of those companies I just mentioned have their own issues. The semiconductor companies have problems. People are canceling orders. They're going to have issues. Companies like Meta, formerly Facebook, they have been beaten up by Apple because Apple put in new privacy settings where you can't track users' data as much, and it's causing problems for Facebook selling ads. And that's not going to stop. Okay, that's just not going to stop. I'm sorry. That's why they renamed the company from Facebook to Meta. Meta is a money-losing business, but they think that's their future. It may be, it may not be. I don't know. But right now, Instagram is losing market share to Snapchat and TikTok. Facebook is losing users, and the privacy settings are preventing them from selling it. Look, these companies used to be growth companies. I know, I get it. I know you think they're growth companies, but they're not anymore. They used to be growth companies, and you have to get that figured out. When the facts change, you have to change your mind. The growth companies right now are food and beverage companies, energy companies, airlines, and apartment companies. That's pretty much it. So last time we looked at these stocks and we said, well, here's what's coming up next week. This was from Barron's, the biggest companies reporting this past week. So I don't know, let's take a look and see how they did, because it was a mixed bag. Yeah, Adele says Netflix went up. Yeah, so okay, so wait, we'll look at Netflix in just a second because they reported on Tuesday. But suffice it to say that is an interesting stock again, because the stock is beaten up. It went down a lot, and that's for a reason. Their subscriber base was shrinking. They weren't getting as many new subscriptions. They lost subscribers. Things are suddenly getting less bad, and now they're starting to get good again. That's really a good time to buy a stock, when things are suddenly getting better, but the stock price is still depressed. If they can keep doing what they're doing and building subscribers, then the stock is going to look cheap, and we're all going to feel foolish for not having bought it this past week. Anyway, we'll look at that in a second. So let's look at Johnson & Johnson first. I didn't format any of these slides.
Yeah. Well, I got some negative names for you there, Brad. Shares of J&J, they're in focus after the company topped earnings estimates on the top and bottom lines as sales increased nearly 2% worldwide. Seen the stock down about 2% here in the early going. J&J, top ticker on the Yahoo Finance platform. And you did see J&J slash or rein in some of their full year sales and earnings guidance. I think that's what the stock is trading off. But look, a good quarter for Aveeno and Neutrogena. I buy a lot of those products. Good quarter for that. Maybe not a great quarter elsewhere in the business, but I like me some Neutrogena.
Big time self-care
I mean,
quarter
you don't look
J&J.
this young if you're not putting
Didn't they
lotion on
get-
your face.
Wait, I
come
thought
on.
they got rid of those businesses.
No, they have looked like they had Avena.
They still have that stuff?
Yeah, I don't think the big company is split up yet.
Okay,
Yes,
got it,
yes.
got it.
So maybe I can't have this conversation a year from now.
Okay, but
There
you
we
can
go.
have it while you can.
Yes.
That updated forecast, by the way, was interesting to me because they did bring the upper end up a little bit, but it's still below what analysts have been predicting. So the new forecast for sales is $93 to $93.5 billion. You see the
Yeah, so let's look at this slide right here that they're looking at right now. Now, the company had a great quarter, no question about that. But they reined in their guidance, and this is called narrowing the range. Let me put my camera back on. This is called narrowing the range. So the previous guidance was that they were going to earn $10 to $10.10 per share. And they brought the low end up. That would be good. But they only brought the low end up by 2 cents, and they brought the top end down by 3 cents. So it was kind of a guidance cut. I mean, only by maybe a penny or half a penny. But still, in the early going, the stock traded a little lower in the pre-market. But ultimately, people realized that there was nothing wrong with this. You know, you can't always, say your range is a dime. At some point, when you have more clarity, you have to narrow the range. And probably what's going to happen is they're going to earn $1.05 or $10.05. Like when you see this $10 to $10.10, all the analysts are going to build their model to say $10.05. So this revised guidance is not out of the ordinary. They're just tightening the range. So not a big deal. Company had a good quarter.
new earnings forecast here, but that is disappointing vis-a-vis what analysts had been predicting here. And this is one of the many, many companies that is going to have negative currency impacts, and that's what they're blaming the lowered forecast on, because J&J is such an international company. It makes sense that they would be seeing a hit from that.
Yeah, that really hit the international side of the business as well here.
What she
as
said
we were
right
kind of
there
breaking.
is really important. I want you to think about this when you're looking at your stocks that you're buying for your portfolios. Companies that have international sales are going to have a hard time going forward. The reason, of course, is because the dollar is so strong. It's a great time to travel. I plan on traveling. Like every other currency is super cheap. Like traveling is on sale right now. However, what happens is that if, let's say, for example, the British pound used to be $2 per pound, and now it's only $1 per pound. It's come down about 50%. If you have a company that sells a lot of things in the United Kingdom, those sales are going to be the same dollar amount in pounds sterling, but that gets translated into fewer and fewer dollars, unfortunately. So when they translate that currency and report their US earnings, the international sales are going to be worth less and less. And so be cautious when you're dealing with companies with a lot of international operations in this environment. The dollar's strong because we're not printing as much money and we're raising interest rates, and inflation is hitting
Down some of the
else.
numbers a moment ago. Just taking a look at the report here on my screen as well. The international segment, to your point, that had actually seen a reported decline in their regional sales results of about 0.3% there. So a little bit of that impact due to FX. You mentioned consumer health. Of course, there's going to be a new name going forward. Make of that what you will for consumer health. Kenvue, really interesting names that people are coming up with these days. But anyway, looking at some of the pharmaceutical segment as well, they had actually seen some growth there to the tune of about 9.2%, which is really driven by a biologic for the treatment of multiple myeloma, and then additionally Tremfya, that's for the treatment of adults living with moderate to severe plaque psoriasis.
Okay, so they mentioned a couple other things that I guess we should point out. And normally I don't want to focus on one individual stock too much, but J&J is a big one. It's a big component of all the major indices. It's one of the larger healthcare stocks. And they alluded to the fact that the company plans on splitting apart. When you walk into a pharmacy, J&J sells pretty much 75% of the things you see, from Band-Aids to Tylenol, the prescription drugs, all that stuff. Anything you see on the shelf, they make it. So what they're trying to do is separate out their consumer products like the Tylenol and the baby shampoos and the lotions from their pharmaceutical business, where they're developing new drugs and new vaccines and things like that. Because as you just heard, the consumer products line was down, and you can see it right here on the screen, was down 0.4% for consumer stuff, but the pharmaceutical stuff was up. And so they want to split off those two segments and have two separately traded companies, because they feel like the pharmaceutical business is faster growing. And a lot of companies do this. They want to be a higher growth business so they can have a higher stock multiple. Pretty simple. So that's what they're up to.
Nice.
All right. And the stock chart looked a little bit like this. Pretty good day. And then traded a little lower at the rest of the market, and then traded higher. By the end of the week, they were up pretty significantly. It was a good earnings report, good earnings beat. Netflix. Here's a really interesting one, and I'm glad, I think it was Adele mentioned it in the comments. Netflix was up a lot this week because they've turned the corner. This would be like one of the first companies that was really beaten up. It was obviously a darling during COVID lockdowns because everybody just wanted to Netflix and chill. But then when Netflix had issues, a lot of it was because, okay, lockdowns are over, we want to go outside again, and we don't want to watch so much TV. And I think there were more things to it that a lot of analysts didn't really get into, because personally, I have T-Mobile for my cell phone service, and I get free Netflix because of T-Mobile. So they added millions of subscribers because everybody who has T-Mobile got Netflix for free. But then a year later, there wasn't that subscriber growth anymore, and it was a decreasing rate of growth, and it actually declined a little bit. So that's one of those things you have to look out for, declining growth rates. But now it turns out they've turned the corner, and those really bad comparisons last year when they had declining growth rates are now we're comparing it to this year where we have growth again. So we're comparing growth to declining growth, to negative growth. And so when you see something like that, it's pretty amazing. And that's something that can really turn a stock around. And the stock's still pretty beaten up. So it's an interesting stock right now.
Earnings, they are imminent. Our Julia Borston standing by with everything you need to know, and you will hear from her momentarily. We also have Vertis's chief investment strategist, Joe Terranova, and SVB Shannon Sakosha. She owns Netflix. They're here to break it all down. We're going to also kick around this rally in stocks, get their view on how long it can really last, especially in light of those late-day breaking Apple headlines about a cut in iPhone production. Stocks lost a little bit of momentum on that news. They did rally back, though, and finished for a really strong couple of days. So, Shan, we're waiting on Netflix, and the numbers are crossing as we speak. We can pop up the stock, and we'll show you that. And I said our expert, Julia Borston's going through this. We're going to have all the analysis on the other side. And you can see it looks to be an initial move higher in the OT. But what do you want to hear?
We definitely want to hear more than 1 million subs this quarter. We want to see 4 million subs for the fourth quarter. But most importantly, we want some clarity on the ad tier. They've priced it below Disney Plus's lower ad tier. And so what we're looking for is, are we going to get some anticipated estimates around what that ad tier is potentially going to cannibalize? If we look at where the valuation is, though, Scott, we think that it's reset to an area that really is coincident with 5% revenue growth, which is what we're looking for on a long-term basis.
Yeah, you see the stock really popping higher. Julia, do I have this number right? Did they do 2.4 million subs in the third quarter?
Yeah, so that was the key thing here. Netflix beating on the top and bottom line. But before I get to the earnings and revenue numbers, we need to look at the paid net additions. The company adding 2.4 million streaming paid net additions. That's versus expectations of the addition of about 1 million. They had been guiding to 1 million. The guidance also better than anticipated. Netflix guiding to the addition of 4.5 million paid subscribers in the fourth quarter. Analysts have been looking for around 4 million, so better than expected as well. And the company beating estimates on the top and bottom line with earnings of $3.10 versus the $2.13 estimated, and revenues of $7.93 billion, a hair ahead of the $7.84 billion estimated. We see the stock is up about 8% on that news.
We don't have to watch the whole video clip, but let's break that down. So you remember when we talked about accounting, the top line is literally the top line. It's the revenue, right? It's the top line. And then you have your expenses, and you have your operating income, your gross income, then your operating income. blah, blah, blah. And then your pre-tax income, you pay your tax, all these expenses get taken out. And then you have your net income. And then you divide that by the number of shares, and that gives you your earnings per share, your EPS. So just to remind you what she's talking about and what they're talking about here, the top line is literally the top line on your income statement, the revenue. The bottom line is literally the bottom line, or it could be this one. Either way, your net income. If you beat on both the top and bottom line, that's great. The stock's probably going to move higher. But what happened with Netflix was even better. They guided towards 1 million subscriber additions, and they put up like 2.4. And then they guided towards adding even more in the future. So again, stocks are not just about the earnings. A lot of it's about the earnings, but it's about the future earnings. If you're thinking about buying the stock today, you don't get that old earnings, right? They already reported their EPS. You don't get that. If you're thinking about buying the stock today, you get the future earnings. You get what you think the company's going to earn tomorrow and the next day and the next year and 2 years and the next 10 years. So the future expectations, that's what really converts sellers into buyers and makes a stock go higher. And that's exactly what we saw with Netflix this week. The stock is beaten up, it's crushed. There were more sellers than buyers. And all of a sudden, they said, hey, we're adding new subscribers and our earnings are beating your expectations. And people had to reassess their expectations. And they're like, well, I only thought that they're all going to earn this much, but now they're going to earn a lot more. I think I should be buying the stock. So shorts were covering their short positions and people started buying the stock, and the stock was up huge. You can see what it did this week. The earnings report on Wednesday obviously was huge, and then the market continued to rally Friday. So this stock did great this week. This stock did absolutely fantastic. So Netflix is back on pace. Oh, I threw this in here too because they talked about the technicals a little bit. And I just wanted to point out that, look, you can pay attention to these technicals. When you're hitting your lower Bollinger Band and things are oversold for as long as they are, maybe it's a time to buy the stock. I mean, it was way oversold, and then it rallied harder. And now we're at a point where it's not overbought, but it is topping on its Bollinger Bands here. So, you probably have time to buy the stock. I don't think it's going to rally as hard as it did in midweek. It's a little stretched here, but I would think over the long term, if they keep doing what they're doing, this is a stock that's going to do well over the long term. They create a great amount of fantastic original content, and everybody likes Netflix. So I don't know anybody who doesn't like Netflix. All right. Oops, I went backwards. Okay, Procter & Gamble reported. Let's see. Yeah, I'm covering all of these, and we're gonna cover each of these. So we're up to Wednesday now. So Netflix jumped on Wednesday. And then P&G reported Wednesday morning. Let's see what happened with Procter & Gamble. Mind you, this is consumer staples, okay? This is a company that you should not think of this as a growth company. But suddenly,
you mentioned P&G, you flagged that. We're going to give the people what they want. Procter & Gamble out with its latest earnings this morning, beating on the top and bottom lines. Higher prices, offsetting a drop in demand for its products. You're taking a look at shares here pre-market, up by about 1.8% here. A few things to really break out here. I mean, it was this strength, at least in healthcare. The prices, yeah, that was up 6%, but that was the smallest of the price increases that they had seen, while the organic sales actually tied for the most growth, 8% year over year within that category alone.
Yeah, so the volumes in this business were under pressure, but the organic sales, that's a key measure that everybody on the street looks at for Procter & Gamble. That was up across the board. Beauty, grooming, healthcare, fabric care, and baby care, all up. I asked CEO John Moeller if he is seeing signs of a recession in his business after this quarter.
Purely from a consumer demand and willingness to spend standpoint, we wouldn't predict a recession. But again, I'm not saying there's not going to be a recession. There are many things that go into that.
It seems like P&G, Julia, is taking this notion, we're going to maybe lose that marginal consumer, that lower income consumer, and we're going to really go more all in with that higher income consumer that can spend more on whatever innovations they're bringing to market, and that looks to be shining through here as well. Also, too, I think the market likes, they've not cut guidance for their core earnings per share. And they were a little more cautious in total sales, to your point, because of the dollar. But at least that core earnings number, it looks like it may stay intact for them.
They didn't cut it, but they said it might come in at the lower end of it. Why? Currency effects,
yes, yeah.
right? So this is, again, the refrain here. And just to get specific there, $3.9 billion after tax this year as a result of currency effects plus higher commodity and material cost as well. They had given this guidance before, but this is a $600 million increase of costs from that prior guidance. So to
yeah, so I mean, here's what's happening with a lot of the consumer staples companies. So they've all been complaining and the stocks are beaten up because they had higher input costs. Commodity prices were higher, but now commodity prices are going lower. And these companies have already raised their prices to offset those higher commodity prices. And they're not going to cut their prices. The prices went up, they're going to stay there, and their expenses are going to go down. And so they're going to have higher revenue and lower expenses going forward. That's my expectation anyway. And I think a lot of these, not just food and beverage companies, but consumer staples companies in general, are going to do really great. The stocks are going to do really well going forward.
your point, Oz.
All right, and so it was a mixed bag. Look, the stock got a real big pop. It ripped, and then it kind of settled down. So nothing great going on. About a positive week. IBM reported then. Okay, here's another tech stock. This is like a pure play tech stock.
A beat on revenue and a beat on EPS profit, about 4 cents above estimates. Also, the company raised its full year revenue guidance and maintained its full year free cash flow guidance. Sorry for that stumble there. When you look across at all the segments, a broad-based beat. You look at software, revenues of $5.8 billion compared to an estimate of just over $5.5 billion. Look at consulting, revenues of $4.7 billion versus an estimate of just over $4.5 billion. Infrastructure, a similar story. One thing to note here, the company did flag a stronger dollar as a headwind, but still EMEA and APAC both up 16% when it comes to revenue. Also important to note that this beat on profit came on lower expectations. Just about 2 months ago, the EPS estimate was $1.91 a share. But again, IBM beating current EPS estimates by 4 cents a share. You see right now, shares of IBM up just about 5%. Back over to you.
You make a good point, Frank, when you suggest that they maintained their free cash flow guidance, which they did lower last quarter to the bottom end of the range. So that helps us keep the whole thing in perspective as we're watching what's taking place in the software business with enterprise, just the whole thing, rising labor costs, you name it, right there in the soup of dealing with it.
Yeah, absolutely. I mean, I think a win for them here is they had double-digit growth when it comes to their Red Hat business, their hybrid cloud business. In general, IBM believes that we're not just going to see one hyperscaler win. There's going to be a multi-cloud strategy with on-prem still a part of the plan for many companies. So overall, a very positive quarter, especially when you count the fact they get more than 50% of their revenues overseas, the stronger dollar, the dollar up, I believe, more than 15% year to date. So in general, a very optimistic outlook going forward.
Yeah, thank you, Frank. We'll talk to you again if we need to in a moment. Josh Brown, let me come to you now. I mean, no disrespect to IBM, but given the stock performance relative to the market and relative to some other tech companies, is boring tech better right now?
Well, this is the type of stock that appears in all of the low volatility screens. So it's going to.
All right. So listen, he has a good point there. Boring tech is good right now. IBM's cloud business competes directly with everyone else's, including, Microsoft Azure and Amazon Web Services. But it's a big piece of their business and it's growing and it's doing really well. So the stock ripped on Thursday and continued higher with the market rally on Friday. So some tech stocks are okay. Not all of them. And I'm warning you, not all of them. Some of them are okay, not all of them. All right, now here's what you guys wanted to hear, because when I look at, hold on a second. We'll look at this in just 1 second, but I'm gonna flip over to it right now just because I have the opportunity. Let me see the Youth Sustainability Investment Challenge. Let's see what you guys have been doing. Let's go to the dashboard real quick and see. And the most trades are in Tesla. Wow. 151 trades. Okay. I don't know why, but okay, whatever you guys want to do. Let's see how Tesla did. Let's see what happened. Oops.
In terms of revenue, you have a slight miss on revenue, not by a lot, but a slight miss. The estimate was for $21.96 billion, came in at $21.45 billion. They did beat on the bottom line, earning $1.05 a share. The estimate was for 99 cents a share. What we're trying to hunt down right now are the automotive gross margins ex zero emission credits. We have it with zero emission credits at just over 30%, and the estimate is for it to be at 28.5%. If it's around there, it's not going to be a huge move one way or the other. But then you have operating cash flow at $3.3 billion. We're just kind of diving into the numbers right now, Scott. But the bottom line is this. You have a slight miss on revenue, but you do have a miss, or you do, I'm sorry, have a beat in terms of earnings, with Tesla earning $1.05 in the third quarter. The estimate was for 99 cents a share. Scott, back to you.
We're all in the same car. I was going to say we're in the same boat, but we might as well use the car analogy, Phil, because it's all trickling out very slow. So I feel your pain as you're trying to get to the bottom of the numbers as much as we are. So that's why you can't go anywhere, really, because we'll get you more details on to why the stock initially looked to pop and why it had seemed to turn around. But it's moving as we speak, down about 7%. Dan Ives, of course, the star analyst of Wedbush, who covers this company. Hang on, Josh, real quick. You want to give me an initial reaction to at least the top and the bottom line while we get to the bottom of deliveries and the things that matter most?
Look, I think ultimately, if you look at margins, I think generally in line with where the street was hoping, a little bit of an EPS beat. I do think bulls are maybe hoping for more just in terms of maintaining margins. But the big thing, as you talk about, Scott, it's about Q4, the 50%, especially with China. That's why this is a moment of truth for Tesla, at least in the near term, to sort of navigate some of the logistical and other issues they've had. And that's why this is going to be, in my opinion, probably the biggest conference call from Musk in the last 2 years.
And you expect them fully to be on it?
Oh, yeah, we expect them to be on it. And really, I think the key variable is about...
And he was on it. He was on the conference call. But, okay, so this was a mixed bag. So remember, the top line is the revenue line, and that was a miss. But the bottom line and the earnings per share was a beat. So look, that gives you kind of mixed feelings. And then the guidance wasn't that great. So, I mean, yeah, is it a growth company? Yeah, sure. Do they have great products? Yeah, sure. Is it a great stock? No, it's still overvalued. It's still way overvalued. And that's what the market told us this week. And so you saw the earnings report. Now, overall, like compared to last week where it closed, it was in the green. It was up. But look, we had this. There was not a good reaction to that earnings report. It just was not favorable at all. Remember, it's not just the earnings, it's the change in the growth rates. They had a revenue miss. That was unexpected. That's a big negative, and that might carry over into the future, and people are worried about that. So, all right, so enough about Tesla. Let's talk about, on Friday, we had AT&T. That was the last big one.
AT&T looks like it is just out with its earnings, and adjusted numbers, it looks like came in at 68 cents a share. That is well above the street was expecting. Street was looking for 61 cents. Revenue also beating, it looks like $30 billion versus the $29.8 billion that the street had estimated. And if you look through some of the numbers here, they've got a lot of good news. They're talking about 964,000 total postpaid net adds and 708,000 postpaid phone net adds. Through the quarter, they were talking about through the third quarter, if you're looking for the full year, that gets them to what they are saying is the industry best 2.2 million in postpaid phone subscribers and 338,000 AT&T fiber net adds. That, they say, is the second best quarter for AT&T fiber subscriber growth in the company's history. Wireless service revenue up by 5.6%. That's the highest year-over-year growth in more than a decade. And as a result of all these things, the company is now raising its guidance in a few areas. They now say that they expect to reach more than 130 million 5G mid-band POPs. That would be point of presence, the network interface point. 130,000 5G mid-band POPs by the end of the year. Earlier, they had said they thought it would be 100,000, 100 million by the end of the year, and that's nearly double the target they had at the start of the year. Also talking about consistency of customer and ARPU growth. They're saying as a result, they're going to increase their wireless service revenue growth expectations. They're now looking to 4.5% to 5%, and at the beginning of the year, they had been talking about 3% or better. And for the adjusted earnings per share from continuing operations, they now say it'll be $2.50 or higher for the year. If you look at the street, I think the street's at $2.56. I'm not sure if that's an apples to apples match, but they are raising at least what they are telling the street they'll be expecting to hear. We're going to be talking to AT&T's CEO John Stankey. That's coming up at 8 a.m. Eastern time. This is a first on CNBC interview. And guys, remember,
but the earnings report was really good, so he's going to be happy about that.
Last quarter, it looked like they had pretty.
So the stock was off to the races, and this is a stock that, let's face it, it's been dead for a long time. They're losing market share to T-Mobile. They have continued to lose market share, but now they're building out product lines like Verizon, where they're building fiber optic into the home. And so that's an interesting thing that's growing for them. And then suddenly they're beating revenue estimates and earnings estimates. So that was pretty impressive. I didn't expect this out of AT&T at all. But let's face it, it's a utility. It's one of those things where they can just simply raise prices and you have to go along with it. It's not like consumer discretionary. It's not like industrials or basic materials or technology. This is the kind of company that's more like a utility. It's kind of akin to consumer staples like food and beverage. If the world is ending, you still need to eat and drink, and you're probably going to use electricity, and you're probably going to try to use your cell phone. And this is what's going on with this company. They've raised prices, and they're getting into different lines of business, and it's working out really well for them. So again, don't think for even 1 second that growth companies have to be tech or have to be telecom or have to be semiconductor companies or something like that. There are certain growth areas in this economy right now, and they're not the places you might expect. It might be utility side telecom like AT&T. Netflix apparently is growing again. Food and beverage companies growing again. Staples companies like Procter & Gamble, Johnson & Johnson growing again. Interesting stuff. Now let's look at the bad. Let's look at the good, bad, and the ugly. Let's go straight to ugly. Let's go to ugly.
Earnings coming in at a beat, 8 cents versus the flat earnings results that were expected. Revenue did miss by a hair, coming in at 1.13 billion versus the 1.4 billion expected. And daily active users were stronger than anticipated. The company adding 16 million daily active users in the quarter for a total of 363 million. The street had been expecting the company to report 358 million. What was driving the greater daily active user growth, whereas revenue was just a hair light of expectations, is that average revenue per user was lower than anticipated at $311 versus the $321 estimated. Now, there is a key stat here that is what is really driving the stock down 12% right now. The company gave some insight into Q4 revenue growth, saying that so far in Q4, they've seen revenue growth of about 9% year over year. But they say that visibility remains incredibly challenging, and this is compounded by the fact that revenue in Q4 is typically disproportionately generated in the back half of the quarter, which further reduces visibility. They said, given all those factors, they're not going to provide formal guidance, and they warned that they believe it is likely that year-over-year revenue growth will decelerate as they move through Q4, due in part to various things, including relying on brand-oriented advertising. And they have set their internal forecast based on the assumption that year-over-year revenue growth in Q4 will be approximately flat, and also estimating adjusted EBITDA would be about 200 million under that.
We can stop it right there. Listen to what she just said. Their revenue growth is going to be flat. Their internal projections are revenue growth is going to be flat, which means no growth. And that is not something you want out of your tech stocks. Tech stocks with declining earnings, declining revenue, flat revenue, that's bad. These are supposed to be growth stocks, right? We all think of them as growth stocks. But the reality is there's no growth here. There's none. They've revised their revenue estimates lower. And that gets back to what we talked about in slide number 2. rate of growth. Bullet point, I think that was bullet point number 3, rate of growth. So rate of growth is declining. It was growing and now it's not growing. That's bad. And so the stock is down. It got absolutely destroyed this week. It's going into penny stock territory. Honestly, I think this company never turns a profit, and probably the stock goes to 0 eventually, or it gets acquired by somebody else. Maybe Facebook tries to acquire it at some point. That would be cool because they need some growth. I don't know if the regulators would allow that because they buy everything, but we'll see what happens. But the reality is, like, and everybody knows it now, it's not a stock that's going to make money. It's kind of like there's so many companies that came out during this bubble that are never going to be profitable. And like Warren Buffett said, when the tide goes out, you see who's been swimming without their shorts, something to that effect. He said swimming naked, actually. But now we've got this situation where we've got all these companies that were trying to grow their way to profitability, and they're not going to make it. They're just not. There's no more free money for them. They're not going to become profitable. They're going to run out of cash, and they're going to go bankrupt. And so this is an interesting take I heard from Cramer on Snapchat in particular.
Let's talk a little bit about what's happening with yields versus with equity futures. That's been the story again and again over the last several sessions. That's why we see equity futures down this morning.
Well, I mean, look, it's the painful bond situation just seems endless, and it's still in control. I do want to take the other side of the imbroglio of Snap. I think Snap is a loser. I think it was always a joke site meant for teenagers, and with then artificial content put in that nobody really liked, that you're advertising against. So I'm not saying that it was. Let's just say it wasn't ever a real company. It wasn't a company. It wasn't a company. It was a site to be able to make it so kids could be able to talk to each other.
Yeah,
and they tried to make it into a company, and they haven't made it.
So you're saying that you're taking the other side, that this shouldn't be spread to other social media stocks, that you wouldn't take down Meta. If you go back to what Procter & Gamble said, right, if you go back to what John Mueller said, he said, without a doubt, the best channel is the internet channel. So what he's thinking, therefore, is Google. It's thinking about Amazon. And I believe he's also thinking about Meta, Facebook. And what's happening, I believe, is Snap's like an afternoon newspaper. It's going to go away, and it gives more ads to the morning newspaper in the old days. So the equivalent is Amazon. And I really think that people have to recognize if they've ever been to Snap. I was on Snap this morning. I mean, it's just a joke. I mean, I wouldn't read any of those, like Casper mattresses amidst like articles about people whom nobody cares about. And there's really interesting posts in Facebook. I buy a lot of things off of Amazon. I buy a lot of things off of Google. I would never buy anything off of Snap. Snap. Hey, can I
mean,
ask
look,
you?
Why don't they just set up a site that nobody cares about past they're 18?
Well, I've got a
people invested in
who uses it.
All right.
People
I
invested
know
in
you
this.
guys are all going to disagree with this. Probably all have Snapchat accounts. But anyway, that's what happened. Snapchat's probably going to go to 0. Don't buy the stock. All right. So here's what we have coming up. A lot of big names. All right. And some of the names you like. So let's see what we've got coming up this week. Here's what's coming up in terms of earnings. We've got Microsoft. We've got Google, now known as Alphabet, both classes. We've got Visa, Coca-Cola, one of Warren Buffett's longtime largest holdings. Novartis, Texas Instruments. Okay, that might be tricky because there's a chip company. UPS and Raytheon Technologies, selling missiles worldwide. All right, it's going to be a busy week. That's, I think, on Tuesday, because not a whole lot of companies reporting on Monday. Let's see. Oh, Wednesday. Oops, I put this too low. I moved the thing too low. Darn it. Meta. I don't expect a lot out of them. That could be a bad day. Thermo Fisher Scientific, great company in the biomedical space. Bristol Myers Squibb, also same kind of healthcare space. Good companies. Healthcare stocks are cheap, and the companies are doing well. Look, don't overlook them. Don't overlook them. It doesn't have to be software companies and app companies and semiconductor companies in your growth portfolio. It can be healthcare. It can be consumer staples. Okay, it can be utilities these days. It can be telecom companies like AT&T. Okay, ADP and then Boeing. Boeing, one of the largest industrials. Okay, that's gonna be a big one. And then Thursday, we've got Apple. Oh my goodness. And you know what? They've introduced the new iPhone 14. It's fantastic. I am personally gonna upgrade my phone because I can't stand it anymore. I've got an iPhone X, otherwise known as iPhone 10. I've got to get a new one. So I'm probably gonna get 14. They look pretty good. The cameras are just unbelievable. Once you get locked into the ecosystem, you can't get out, by the way, because they have all, first of all, they're very secure and they have great privacy rules, but they have all of your pictures, contacts, everything all locked up in the iCloud. And so when you buy a new phone, you just plug it in, boom, everything. It's just like a brand new phone, but all your stuff is there. You really can't go wrong with it. I mean, it's harder for other companies because I know there are a lot of good software companies and hardware companies. All the other hardware companies use the Google product, like what do they call it, Android, as an operating system. And so there's not really that seamless integration. So anyway, that's just me. MasterCard, Merck, Shell, Royal Dutch Shell, which is the, by the way, owned by the Queen, who recently passed, may she rest in peace. That's what the word royal stands for in Royal Dutch Shell. It's owned by the royal family of England, like in a joint partnership with the Dutch. And McDonald's, great company, wonderful company, McDonald's. And then on Friday, we've got ExxonMobil, Chevron, AbbVie, NextEra Energy, and this is like a green one. So if you were participating in a renewable energy kind of competition, maybe this is the kind of company you should look at. This one, I know you all already picked Tesla, but check this company out. I'm not saying to buy it. I'm just saying check it out. This is the kind of company that's kind of like, it's an energy company. Yeah, I know, but it's a kind of a green energy company. So if you haven't heard of it, maybe buy this instead of Tesla. Just saying Tesla's not a good stock. No. So anyway, Sanofi, ICICI Bank. Okay, whatever. So ExxonMobil, though, this is serious. So this stock has been beaten up and beaten up and beaten up, and now it's at an all-time high. It hit an all-time high. So with the OPEC cut of 2 million barrels per day, energy is investable again, and ExxonMobil is at an all-time high. If you're participating in our renewable investment competition, then you know maybe Exxon's not the best stock to pick. But if you're participating in other investment competitions where they don't have a focus necessarily on sustainability, then maybe ExxonMobil is a good stock to buy. Just saying. Chevron too. Those are the two largest oil integrated producers. Not only exploration and production, but refining, distribution, and retail sales. So these two companies together make up a huge part of the energy sector, and they're both doing quite well. All right. So what was going on this past week? Oh, wait, we talked about this last week. Let's revisit what we talked about. So we had a few things that were coming up. I didn't even look at some of these, but I mean, housing starts and building permits, huge economic drivers. If you've taken a class with me before, you know exactly what I'm going to say. When there's home building, there's huge economic activity. You have to hire a lot of people and buy a lot of things. And the people you hire buy a lot of things, right? You have to hire, first of all, the architect and the landscaper, and then they get out their excavators, which is Caterpillar products like bulldozers and whatnot. They're excavating the foundation, and then you get the stonemasons in there. They're going to build the foundation. Then you get the carpenters to frame out the house, and then you've got the electricians to put in the wiring, and you've got the carpenters to put on the glazers to put in the windows, and the roofers to put on the roof, and then you get the plumbers in to put in the copper plumbing and the heater, and install the air conditioning. All these machines, the washer and dryer, the stove, the dishwasher, all these things that come out of factories. huge, huge, huge part of the economic development of any country, but especially in the US, home building is a huge part of what's going on. And so what happened wasn't really good. And the reason is, of course, interest rates are up a lot and mortgage rates are up a lot. They're up huge. And so we didn't have really good numbers out of the home building sector.
Welcome back to Squawk Box. Rick Santella here live at CME HQ with the breaking news of the morning. Of course, we're looking at housing starts and permits for the month of September. We all know higher interest rates and a variety of issues have negatively affected housing, expecting 1,461,000, a bit on the light side, 1,439,000. That's on starts. On permits, 1,564,000, a bit better than expected. And if we go to the history here on the start side, well, that is the weakest level just since July when it was 1,404,000. And when we look at 1,564,000 on the permit side, 1,542,000 was our last look. Prior to that, 1,685,000. So you can see the deterioration continues, even though we're not on the absolute lows with respect to permits. Yesterday, we had a sentiment number that was at 38, not very good. And if we consider the split between housing starts with regard to multifamily and single, we would understand that mostly single-family homes have been underbuilt for a long time. And when I look at interest rates, maybe it's not going to get any better, Andrew, Joe, because 2s, 3s, 5s, 7s, 10s, 20s, 30s. If they closed at current yields right now, they'd be new cycle high closing yields. And
wow, you know what? This says a lot about where we're going with the economy. And not only this, but I want you to pay attention to these numbers. The 2s are higher than the 5s, which are higher than the 10s, which are higher than the 30s. The yield curve is incredibly inverted right now. It's horrible. Whenever this happens, there's a recession. There's definitely, we already had 2 negative quarters of GDP growth. The government does not want to admit that we're in a recession, but we are. And this yield curve shows you that that's the fact. And it's going to get worse. It's going to get much worse. So be cautious with your stock picks. I would say, stay with the ones that are growth stocks right now. And those growth stocks are not tech and they're not communications. They are things like utilities and consumer staples and airlines, oddly enough.
The fieste resistance, but maybe not for everybody. The dollar against the yen today is at the best levels, get this, since 1990. Since 1990. Back to you.
All right, so wow, I covered up my thing and I didn't format my chart. Yeah, these are housing starts. They're pretty negative. It's bad. This is bad for the economy. So I mean, I know the Fed is trying to slow growth, and they're doing it. They're doing it this way. Slowing housing starts will definitely have a negative drag on the economy. So anything involved with housing is going to have a negative drag on it right now. All right, and then it's Friday.
So
we didn't even have this on the calendar. I mean, ultimately, though, you see, if you look at trading economics, you see where all the Fed presidents are going to speak, and they're all going to have presentations and speeches before some economics board in their state or their county or whatever. And this is the relief rally that the market needed. And you know what? Here's the weird thing. I'm going to warn all of you about this before we go. The stocks that rallied the most were the junkiest stocks, the tech stocks and the semiconductor stocks. They rallied hard because everybody thought the Fed was going to pivot and start cutting rates. They're not going to pivot and start cutting rates. That's not going to happen. But anyway, the market rallied in large part on Friday because of this.
I want to react first. It's good to have you on. I'm glad you popped on with us. You want to just react to these daily?
Oops, sorry.
So you want to react first? It's good to have you on. I'm glad you popped on with us. You want to just react to these daily headlines, Mary Daly? At or close to neutral requires a step down into smaller increments of hikes?
I mean, I think it's worth pointing out, Scott, that Daly is one of the more dovish members of the Federal Market Committee. And let's not have a memory that's shorter than 24 hours. That I believe we were on this show yesterday when Patrick Harker from Philadelphia made some hawkish comments, and he was going the other way on this, and the market went the other way. And so there is a diversity of opinion out there. I don't think what Daly's saying is really that far out of bounds of what the market was priced in. I will say at the moment, you've had the peak funds rate come off, Scott. You were up near 5, now you're 487, so a 13 basis point decline. What this is doing is introducing doubt on the far end of what the Fed's going to do. She's still citing the 4.5% funds rate, which is part of the summary of economic projections from the Fed. The question is what happens beyond that. I think one of your panelists was just talking about that, Scott, that we're still got a 75 in front of us and a 50, say, at the end of the year, which is pretty much where the market was, with the debate being where's the pause and where do you go from here. I always had questions about how far the Fed would go before it started to either ratchet down or even stop and pause. But I don't think this is a dramatic change in the outlook for the Federal Reserve.
The market thought it was a
should have been
dramatic
thinking
change
about this already, but they are still, I think, headed for that 4.5% range.
But I mean, you know, what we got in Fed funds 5% even yesterday. I believe it was from May of 23, right? So the market had moved pretty aggressively to where it thought that was going to go. Yeah. And we had kind of conditioned ourselves for 75 in November and then maybe another 75 in December. The Journal story today, I want your opinion of that too. It's not an accident that that story is out today, I don't think. And it's the idea of, you know, conditioning people for what's coming. And I think the most interesting part of that, according to Tim Rose, who wrote the piece, is preparing investors for a decision in the weeks after the November meeting, as he says, without prompting another sustained rally, right? The Fed wants to be able to communicate their strategy without sending stocks surging because it defeats the purpose of ultimately what they're trying to do.
Yeah, I think that's right, Scott. I think that the 75 being built in, that's what we know that's in front of us. I didn't think that part of the story was news, and the question becomes after that, and it's going to depend on the data. If we get a little cooperation from inflation and the Fed feels like it can ease off the 75s. Remember, we're talking about easing off rate hikes. We're not talking about even pausing at this point. You're right. I mean, we are down. We were up at 503 on the April contract. Which was it, April or May? Yeah, it's the May contract.
Yeah, so yeah, too late. They already tipped their hand, and the market's starting to rally. So anyway, let's just look at some of the economic indicators that came out this past week. Home builder confidence crashing, home buyer confidence crashing. This is bad for the economy. Very, very bad. And I think that the Fed is starting to take notice that their policies are taking effect, and maybe they will start to slow their interest rate hikes. And is that good for the stock market? Well, I don't know. I think a lot of companies that have yet to report, particularly in the tech space, are going to come out and report terrible earnings and give horrible guidance. And that might drag the market lower. However, the Fed is obviously, some of the governors are thinking about what's going on with the economy and seeing that the economy is slowing and that maybe they can slow their interest rate hikes. And so there are balances here. Things are balancing one another. The problem, though, is that we still have massive inflation. And now the problem is that we have weaker economic growth and we still have super high inflation. So that is bad. And that's something that the central banks all around the world are going to need to fix. And the Federal Reserve is definitely going to try to fix this. And they're going to hike interest rates until they get this under control. And they don't care if this one keeps going lower. They want this one to turn around and go lower. And until that happens, they're not going to quit hiking interest rates. So keep that in mind. But because we can invest in so many different countries, you know, take a global view, take a global macro view. This is from Statista. You can check that website out. And you can see that it's not as bad here as it is in other places. We've got a lot of problems around the world. Always Argentina is having issues. They're one of the worst, I swear. Turkey, they've got their problem. Angola, they've got their problems. I mean, you just look around the world and see what's going on here. Not that you're going to invest in Angola, but I know that there are some South American stocks in which you can invest in our stock picking competition. So, and some Middle Eastern, Asian stocks as well. So be cautious of those stocks. So I'll leave you with this. The reason inflation is declining is because we're depleting our strategic petroleum reserve, and we're trying to offset OPEC cuts by just selling oil out of our tanks in Cushing, Oklahoma. And it's working. The price of gasoline is down substantially. It was really high, and now it's really high, but not as high as it was. So anyway, it's a little bit lower, so that's working. And the problem is this cannot continue forever. At some point, we're going to run out of oil to just like dish out into the economy. All right, so what's upcoming this week? Let's talk about this before we wrap it up for tonight. We got new home sales. This is going to be a big report. We've got GDP. This is the biggest one. This is the big one, the biggie. This is the big report here. GDP. Now, I know this is a lagging indicator and it's a look at the past, but let's face it, GDP growth rate is like the biggest thing you can look at. The previous two have been negative. The forecast is for positive. I don't know if it's going to be positive or negative. We'll see. If it comes out negative, it's going to be auto recession, and the stock market's going to have a hard time going up this next coming week. If it's lower than expected, same situation. If it's in line with expectations or higher than expected, then you know what? The market might rally next week. So you got to really pay attention on Thursday. And then Friday, if you're covering consumer stocks, personal income, and personal spending, especially if you're covering consumer discretionary stocks. And so that's it. So pay attention. All right, guys, that's it for me. That's my report on the markets and what to look for next week. We got a lot of earnings coming up. We got a lot of economic reports. Wednesday, Thursday, Friday, market's gonna be choppy. So hang in there, buckle your seatbelts, okay? All right, everybody, if you have questions, feel free to ask. Otherwise, have a good night. I'll see you next time. Bye-bye, everybody.
请问有回放吗？有谁知道有回放吗？